Hello and welcome to the very first session of SBR Rapid Revision series. And in today's session, we are going to look at the 30-day study planner, which is being revealed in order for you to follow from the 4th of May. Today is 1st of May. So you'll be following it from 4th of May until the exam on 4th of June. So 3rd of June, you are expected to have this completed. I am Raza Idris, an experienced ACCA tutor specializing in FR and SBR. First, I'll be taking you through the different areas that you're supposed to focus on different days of this 30-day study planner. Thereafter, I'll be taking you through the tips that you are supposed to follow in each of those specific days relevant to each of those specific areas. Now, when it comes to this study planner, this is a combination of technical revision as well as practical revision. So you will be focusing on the theoretical aspects as well as the exam practice aspects as well. So you can use this study planner as it is holistically, or you can tweak it as you find comfortable depending on certain topics. So on the day one, you're supposed to focus on the standards relevant to non-current assets. Now, if you look at this study planner, there is the set of standards that you're supposed to look at on those particular days, while there is a weightage given that shows how important that area is going to be for your June 2026 exams. Now, on day one, you are required to focus on the non-current assets based standards because these standards are considered to be one of the sets of the standards that are examiners' favorite because these standards pop up in every exam somewhere or the other. So the standard that we are going to cover throughout day one is going to be IAS 16, the PPE, the IAS 40, investment property, IAS 38, focusing on intangible assets, IAS 23, focusing on borrowing costs, IAS 20, government grants, IAS 36, impairment of assets, and IFRS 5, non-current assets held for sale. Now, this is going to be your day one. And the exam weightage, as you see here, is high. Very important areas to master, technically as well as practically. And on day two, you will be required to focus on heavier standards. One of it is IFRS 15. Again, these are very important standards as well as a little content heavy, technically complex. So you need to master these standards particularly as well. So IFRS 15 focusing on revenue, IFRS 16 focusing on lease, and IAS 12 focusing on taxation. Now, how you're going to split your days is dependent on how you are willing to focus on these 30 days to prepare for your SBR exams. So you can split these chapters, some towards the morning hours, some towards the evening hours, or if you are studying at a stretch, you can do it by following certain timing techniques that would allow you to remember what you are studying. And on day three, again, there is the weightage is high for this day as well. Day three, another heavy and a complex area which requires a lot of critical practice, critical evaluation, and critical understanding, which is IFR, the financial instruments. So this carries a couple of standards: IAS 32, IFRS 7, and IFRS 9. So based on that, you need to prepare yourself by making yourself technically sound. Therefore, focusing on IFRS 18, one of the newest standards to have been released in the recent past, along with conceptual framework and IFRS practice statements 1 and 2. So this day is going to be a day to strengthen your foundation because everything revolves around IFRS 18 since that has replaced IAS 1. Conceptual framework, which is the underlying area to master for any areas that do not have a standard or even for standard creation, this is the underlying a technical area that is being referred to and reviewed by. And IFRS practice statements 1 and 2, which focuses on management commentary as well as the materiality. Then on day 5, now this is a mid weightage based area, not very difficult, but requires mastery or a complete understanding of all of these areas and standards as well. All right. Although these standards are considerably smaller, considerably easier, but the requirement to apply it during exams would pop up in ways where you would struggle. So for that, your technical understanding of these standards also need to be stronger. So whatever areas I am giving is covering the 100% content of SBR, and for SBR exams, you will have to cover 100% of content. There is no chance to be taken, no estimates to be made, uh, no ideal areas that you are going to be examining. It's always going to be dependent on what the examiner wishes. So don't go to speculate what areas are going to pop up depending on the historical exams. Rather, prepare 100%. There is no chance to be taken. So on day 5, we'll be focusing on IAS 37, which is focusing on provisions and contingencies. And then IAS 10 events after the reporting date, IFRS 13 fair value measurement, IAS 8 basis of preparation of financial statements. Again, now this standard has a new face, a new name. Now, this standard, which used to be known by the policies and estimates has and errors, has got a new name, and there are more areas that have been brought from IAS 1 into this standard as well. So you need to have an understanding what those areas are. Then moving on to day 6, ethics and IAS 24 related party transactions. Again, it's a high weighted area and a very straightforward area to gain marks in SBR exam, because there is going to be question 2 that is going to focus on ethical aspects. So mastering this area, meaning you're mastering one of the questions that you're going to answer. And this is quite a straightforward area where you are required to know the ethical principles, the dilemmas that are there, the threats that are there, and the safeguards. So if you've mastered that, you will be able to score very well in that exam or in that question. And then on day 7, you'll be focusing on IFRS 8 operating segment, IAS 34 interim reporting, IFRS 1 adopting IFRS for the first time, and IFRS for SMEs. Now, this is a low weightage area. Although it's a low weightage area, it's not a no chance area. You will have to know the content of these areas as well, because there have been a lot of times where these standards have been tested from technical standpoint as well as from practical standpoint. And then on day 8, again, a high weightage day. Now, this is focusing on 2 standards that you have been introduced during SBR. Now, these standards never popped before SBR. You've never seen the standards during FR. Rather, these are the new standards that have been introduced as a part of your SBR syllabus. And you will have to master these standards as well. And then on day 9, you focus on group accounting. All right, so group accounting, you see there are 2 days given for group accounting. So you have day 9 and day 10. So on day 9, you're going to focus a certain aspects of group accounting, and on day 10, a certain aspects of group accounting, which we will be looking at when I take you through the specific tips pertaining to each of the days and areas. And then on day 11, analysis and interpretation, as well as sustainability aspects, IFRS, covering IFRS S1 and S2. Again, a high weightage area, because you will have to know how to analyze, how to interpret financial statements, as well as you will have to master the aspects of sustainability, because it has been a crucial area that has been introduced in the recent past into SBR syllabus. And then on day 12, you're going to focus on current and contemporary issues. Now, these are all the areas that we have completed while we were doing the theoretical and technical preparation. So these, you can refer to those tunes as well as study materials in order to master these areas. Now, when it comes to the days that you're spending, and now these days you're not just going to revise theory, you're not just going to revise standards. Rather, there are other things that you'll be doing on those days as well. Therefore, you will be required to ensure that the time management that you're going to do on each of these days is specifically designed in a way that you are comfortable with, and you will have sufficient time to complete all of this and become well prepared for the exam. All right. Okay, so now moving on to the tips on each of these particular days. Now, on very first day where we are looking at the non-current asset standards, there are certain tips I would like to give you relevant to those standards. Tip number one is you need to be in a position to compare and contrast IAS 16 and IAS 40 revaluation model versus the fair value model. Because IAS 16, the property, plant, and equipment, allows the choice of policy for subsequent measurement, either using cost model or evaluation model. Likewise, IAS 40 also allows a choice of policy, whether cost or fair value model. Now, here you will have to know what is the difference between IAS 16's revaluation model and IAS 40's fair value model. How are these two different from each other? Because there have been certain questions in the past exams that have focused on how and what sort of treatment will happen if there are certain non-current assets that stop meeting the criteria of IAS 16 and start meeting the criteria of IAS 40 while they've been following the subsequent measurement model of revaluation from IAS 16. So moving from IAS 16 revaluation model to IAS 40 fair value model, how would that be different from it, or it can be vice versa, from IAS 40 fair value model to IAS 16 revaluation model? How are you going to look at it? Now, let me take you through what the differences are that you need to know and master. Now, when we talk about IAS 16 revaluation model versus IAS 40 revaluation model. Now, there are some specific differences that you have to know in order to treat them accordingly. So, number one is about the time frame of revaluation assessment, right? Revaluation assessment time frame. So, I take IAS 16, the standard requires to do revaluation assessment with sufficient regularity. All right. And recommended time frame is every 3 to 5 years. But once you've selected one of these years, you will have to follow it accordingly. 3 years, every 3 years, 5 years, every 5 years. So it depends on what the different assets are that you're dealing with. And then when it comes to IAS 40 fair value model, right? It's not revaluation model, it's fair value model. So IAS 40 fair value model requires revaluation assessment to be done on an annual basis. It requires annual revaluation assessment. Then point number two, the difference number two is from the depreciation aspect. When I take IAS 16 revaluation model, there is subsequent depreciation. Okay, now subsequent depreciation is going to be based on the revalued amount over the remaining useful life. All right, so this is the subsequent depreciation. But when we talk about IAS 40 fair value model, this requires no depreciation, right? Because you are doing revaluation assessment on an annual basis, the uplift or the decline is recorded then and there. There's no requirement of bringing in depreciation, which again is a way in which you are writing down the cost through the wear and tear and the usage. Since on an annual basis there is fair value assessment that's happening, there is no requirement to depreciate it. And then The third aspect where the difference comes in is from the reporting angle. Yeah, reporting angle. Where are you going to present the presentation? Now, when I talk about IAS 16 revaluation model, there are two ways in which the revaluation assessment would work. Either there would be a revaluation surplus or there will be a revaluation loss. This revaluation surplus will be recognized through OCI and revaluation loss will be recognized through P&L. Now, this is conditional to the remainders in those particular presentation areas. Now, for example, let's say there was an asset that was revalued upwards by 50,000. All right. So that required the asset to be recognized through OCI, the revaluation surplus through OCI. And on the next revaluation assessment, this same asset has been revalued downwards by 70,000. Now, this 70,000 you cannot record through P&L because there is a balance of 50,000 remaining in OCI for that same asset. So first you are going to reduce whatever the uplift that was done to that asset, meaning you will be revising or you will be reversing the effect on OCI, and you'll be first bringing the OCI down by 50,000 and then remains 20,000, which you will be recording through P&L. And if, let's say, there was an asset that was initially on a revaluation loss, let's say first revaluation assessment had a revaluation loss, right? Revaluation revalued downwards. Again, let's use same numbers, 50,000. Yeah. Now this you would have recognized through P&L, presented through P&L. Subsequently, let's say the same asset was on the second revaluation assessment, it was revalued upwards by, and there was a revaluation surplus of 60,000. Ideal reversion surplus is recognized through OCI, but at this point, the entire 60K does not go into OCI. Rather, first you will have to revise this. You'll have to reverse the losses you have recognized because the asset that had the loss recorded, the loss is already there. First, you reverse that loss entirely, and then the balance is what would be considered a surplus for OCI. So, this one you are going to increase 50,000 to your P&L, and thereafter the remaining 10,000 will be recognized as revaluation surplus on your other comprehensive income. Okay, so that's the difference. And then when you talk about the reporting of the presentation aspect for IAS 40 fair value model, all the gains and losses are to be recognized and presented through profit and loss. All the gains or losses. There is no OCI component here. All right. Now that might bring you to a question. Why do we have to use OCI for IAS 16 but not for IAS 40? For IAS 40 is investment property. The intention, the purpose is different. IAS 16, the purpose is to use. IAS 40, the purpose is to gain, right? So those are different purposes, due to which the gain that comes through the revaluation of IAS 16 is considered a low quality gain because you're not going to realize it in the shorter term because you continue to use it. By IAS 40, the gain is considered to be a high quality gain. Therefore, since you may sell it and you may realize it in the short run, which is why the difference of OCI and P&L. All right. So you need to have a clear understanding of the purpose of OCI, why OCI is being used. All right. Because even if you take IFRS, still there is not much of a clarity on the purpose of OCI. But what the guidance and advice has been is any gains that will distort the profit or loss, right? That will distort the picture that's provided by profit or loss will be taken through other comprehensive income in order to maintain the true and fair presentation and view. All right. Then point number two is IAS 38. So here you need to clearly understand the purchased versus internally generated goodwill. Okay, because purchased goodwill can be recognized. Internally generated goodwill cannot be recognized. All right, purchased, you are buying. There is a value attached to it, right? The fair value estimate is there. But when you talk about internally generated, you've got no idea what the fair value is going to be, which is why you are not going to record the internally generated goodwill because it doesn't meet the intangible asset criteria. Okay. And when it comes to purchase and internally generated, you also need to remember that in terms of group accounting, right? Let's say company A has purchased company B. Now, this company B already had internally generated intangible asset. Now, since they were not meeting the criteria of IAS 38, company B was not allowed to record it as per IFRS standard. But now, when company A is purchasing company B, that internally generated intangible asset becomes a purchased intangible asset for company A. Since company A is paying a value to acquire company B. Now, at this point, company A will have to recognize this internally generated intangible asset of company B as a purchased intangible asset of company A. All right, so that's in terms of group accounting. Also, you need to make yourself comfortable with the capitalization criteria of development cost that goes with the abbreviation of PI rate. You need to know what these PI rate criteria are and how you're going to capitalize based on these PI rate criteria being met. Okay. Right. Now, there are technical article references I've given here, so make sure you try to read those technical articles because technical articles allow you to master certain areas that you would not master otherwise. Okay, keep an eye on ACCA technical articles section. Yeah, right. So when you bring the internally generated intangible asset, there will be a fair value adjustment required. You know how the fair value adjustment works in terms of group accounting. All right. Then comes IAS 23. So here you will have to focus on weighted average interest rate, right? And you also need to pay a particular attention to when are you going to start, when are you going to pause or hold, and when are you going to stop or cease the capitalization of borrowing costs. Because there's a limit. You can't be recognizing borrowing cost forever. There is a period, a specific period where you can start, a specific period where you cannot continue to capitalize. Maybe you'll have to pause it. Then there is a particular period where you'll have to stop capitalizing. What those periods are, you have to know that as well. All right. So these are tips that I'm giving you in order for you to rethink, reevaluate, go back and look at the tutorials. All right. Then IAS 20. Here you should be in a position to critically evaluate the impact of conditions failing to be met for conditional grants, right? And how the repayment element would impact the financial statements, right? When there are conditional grants given, there are conditions attached to it. So you can continue to recognize them as far as the conditions are met. But what happens if the conditions stop being met or conditions fail to be met? How are you going to account for that? Because now you can't take that money. That money is not yours. The conditions are not met. You'll have to return it back to the government. How are you going to treat those? How are you going to recognize those? Just do a wide reading. All right. Then the interest-free or below market interest rate loan from the government, how that's going to impact your grant, the government grant, right? Interest free versus below market. So here you need to know that whatever the interest factor, let's say interest free, so the interest amount. If it's below market rate, the balance rate, so that portion is considered to be a government grant. So how is that going to be accounted? And then you will have to know the difference between grant versus assistance. Now, these are the tips for IAS 20. Then IAS 36, you have to focus on indicators of impairment. There are two types of indicators. There are internal indicators, there are external indicators. What are they? Yeah, you need to focus on that. Then annual impairment versus impairment when indicators are present. What are the three areas or three reasons or three instances in which the impairment will have to be done annually? And then when the impairment will have to be tested when the indicators are present, either internal or external. Just think about it. Then impairment reversal cap. So when, let's say, there was impairment testing done on the first go, there was impairment losses. Then after a couple of years, things are getting better and there is an impairment reversal required. But you can't reverse the entire amount. There is a cap, impairment cap, right? You cannot reverse the entire impairment. What is that cap? Yeah. Then revaluation component. Yeah. So here you will have to know impairment reversal cap versus the revaluation component. What happens to the balance? Right. The cap. There's a cap, there's a limit. So beyond that, if the amount is going up, where will that be recorded? Now there the condition is it needs to be held through revaluation model. Only then that balance will be recorded. Cost model, that balance is not going to be recorded. Do a wider reading. All right. Whatever tips that are given, do a wider reading. Go back into your tutorials. Try to understand these areas. Now, these are not the areas that you will focus on very specifically, but these areas can confuse you in the exam, which is why I've given them as tips, and you will have to know them to master these standards. All right. Okay, then VIU calculation, the value in use calculation. What are the criteria? What are the conditions? How can you bring the value in use? Right. What are the limitations? Know that. Then CGU, right, the cash generating unit. What is cash generating unit and how CGU works? How are you going to impair the CGU? How are you going to apply the impairment losses to the items in CGU? Know that. All right. Then IFRS 5 tips for you is disposal group versus held for sale versus discontinued operations. What are the difference between these three items? Then focus on recognition and presentation. How do you recognize, how do you present the IFRS 5 based non-current assets? Conditions to be met for classification as IFRS 5, right? What are the conditions that need to be met? There are certain conditions in order for it to meet the IFRS 5 criteria. What are those criteria? Yeah. Then you also need to remember that there is no depreciation post classification. And then when there's a change to plan of sale, how are you going to reinstate that back? Right? How are you going to bring that back from IFRS 5 to IAS 16 or IAS 40 or whatever standard it was in before? Right? How are you going to reinstate that back once there is change to the plans? Yeah, if sales is not happening, how are you going to deal with it? All right. Then presentation of assets and liabilities separately under current and announcement after reporting period, how it becomes a non-adjusting event, why it becomes a non-adjusting event. Just know that. So these are good for you to know. Okay. All right. And then moving on to day 2, IFRS 15. Right. So you need to focus on the key elements of 5-step model application. You need to know the difference between a principal versus agent. Right. If you are a principal, what would be your revenue? If you're an agent, what would be the revenue? What's the different ways in which you're going to recognize revenue? Right. Then you will also have to understand how the performance obligations work and how the revenue component is going to be recorded. Whether you're going to record a commission or are you going to record the full revenue? That depends on whether you are a principal or an agent. Okay. Then variable consideration versus financing component versus consideration payable when determining transaction price, right? Now, there are different ways in which you can make the payment or you can receive the payment rather. As an IFRS 15 point of view, there are different ways in which you can receive a payment. Either you receive it in cash or credit, or there would be variable consideration, meaning dependent on certain criteria or conditions, right? Then there would be deferred consideration. You'd be receiving it on a future date. So there is going to be a financing component that's going to come in, right? Then the consideration that you are going to pay to a customer who also is a supplier. Just look at those elements. How will those consideration that you will be receiving is going to affect the revenue component? All right. And then to consider how the discount would be applied when looking at allocation of transaction price, right? So discount sometimes, if it's a generic discount, the general discount across all the performance obligations, you allocate accordingly. But if it is not a generic discount, discount given for specific performance obligation, and how you will have to allocate it to that, right? So you will have to know that and how you're going to treat it financially. And then satisfaction of performance obligation, whether at a point in time or over time, there are criteria that allows you to understand whether you are going to recognize the revenue at a point in time or over time. Yeah. Then you have to focus on contract modifications. Yeah, contract modifications. Now, what are the different ways in which a contract could be modified, right? So this is dependent on standalone selling price and the performance obligation, right? The good being distinct or not, right? So know what those criteria are, and depending on that, what sort of modification is applicable and how that's going to be treated and recognized. Okay. Then you have to understand the specific transactions such as consignment inventory, repurchase agreement, bill and hold arrangements, warranties, customer options for additional goods and services, customers' unexercised rights where the breakage happens, non-refundable upfront fees, licensing as an access versus as a right, right? Then sale with a right of return and crowdfunding element affecting IFRS 15. What from crowdfunding is going to affect the IFRS 15 standard? Okay. Then you also have to master the areas of revenue recognition principle when it comes to contracts over time, when outcome is either profit, loss, or unknown. There's a four-step approach that we have looked at. Just go back and do a wider reading. And cost of obtaining versus fulfilling a contract, and how the connection is with IAS 37, right? If there's an onerous contract, how it affects IAS 37, and how you are going to determine the cost of obtaining the contract versus the cost of fulfilling the contract. And then finally, the sale and leaseback aspect of IFRS 15 that has a connection to IFRS 16. How are they connected, right? Where will you be required to know the revenue recognition principles, revenue recognition criteria to understand whether the sale actually happened or not, right? So knowing it is good. Then moving on to the next section of day two, which is IFRS 16. So you have to focus on ROU asset, right? So ROU asset, what's the way in which you're going to recognize or calculate the initial amount of ROU asset? What's the initial recognition calculation? And lease liability, right? How are you going to recognize the lease liability? Usually ROU asset lease liability, there is a connection there. Know what the connection is. Then what is the separating component of lease liability, as well as when will you be reassessing the lease liability, right? Lease modifications. Then lease terms, options to extend versus terminate. Specifically in lease terms, what are the options that are there to extend? What are the options to terminate? And how are you going to deal with those? All right. Then interest expenses versus interest payments. How are you going to recognize the interest payments or record the interest payments? Are you paying it in arrears or are you paying it in advance? So depending on that, the non-current liability, current liability, as well as the interest component will change. All right. Then depreciation of ROU asset. What's the period that you're going to use to depreciate? What period is applicable? Versus changes in lease liability, amortized cost table, right? Using amortized cost table to understand how the lease liability changes from one year to the other and how there are current versus non-current implications, right? In what way are you going to know which part of that is current liability, which part of it is non-current liability? Again, payments in arrears in advance is going to affect this as well. Then sale and leaseback connection with IFRS 15, how both the standards are having connection there, and how to connect for the account for ROU asset and lease liability in the context of sales and lease back alongside profit on disposal. Now for this, go back to the tutorial, look at the formula I have given to you. What is that formula? That formula is the golden formula that you will have to know and you will have to follow in order to recognize the or account for the ROU as the lease liability as well as the profit on disposal in context of sale and leaseback. All right. Then you have the lessor's perspective. Now, so far we've been looking at lessee's perspective. Then there is lessor's perspective, finance lease versus operating lease. Then there is sublease. When you've leased some asset, you lease it to someone else. Sublease. How is that entire area is going to look like? How that entire perspective is going to change the recognition principles. All right, know that. Okay, now moving on to the third standard on day two, which is IAS 12, taxation. So here you will have to understand the concepts of deferred tax liabilities and assets very clearly. You have to be able to distinguish what is a DTA, what is a DTL, and how are you going to recognize those. All right. Specific situations such as revaluation, share option scheme, leases, unused tax losses, how those specific situations give rise to DTAs and DTLs. Then business combination, right? The fair value adjustment, PURP, unremitted earnings, how that's going to create a difference and how that's going to give rise to DTA and DTL. Okay, right. And with that, we move on to day three. Day three is financial instruments. Okay, day three is focusing on financial instruments. A very important area once again. Now, in this, you will have to focus on different areas pertaining to different standards. Okay, so here you have IFRS 7, IFRS 9, and IAS 32. These are standards that are affecting financial instruments. So you have to focus on understanding why amortized table is used, number one. No, we've been using amortized table, but why do you use amortized table? Because there are amortized table is used from the liability perspective, financial liability perspective, as well as some of the financial asset perspective, but not all. Right? When it's an investment in debt instrument, there is a amortized cost table that comes in. Right? So why? What's the purpose of amortized table? Know that. All right. Recognition and derecognition criteria for both financial assets and financial liability. Yeah. Now these are certain areas I am giving as the areas for you to think. Okay, when I'm asking you something, why amortized table is used, I want you to ponder upon it, because once you ponder upon it and you are able to figure out, you will remember it better. Okay, right. So recognition and derecognition criteria for both financial assets and financial liability, right? What are the recognition criteria? What are the derecognition criteria? And what are the subsequent recognition principles that you'll be following? Whether is it going to be amortized cost method, fair value through profit or loss when it comes to financial liability? There is amortized cost, there is fair value through profit or loss. And when it comes to fair value through profit or loss, it is used in specific aspects or specific situations, right? For example, maybe IAS 40. Let's say an investment property was purchased through loan, right? You took some loan, so that's financial liability. To invest or you to buy an investment property. So the gains and losses in investment property is going to be recognized through your P&L, right? Profit or loss. So the interest that you're going to pay on the loan that you've taken to purchase investment property, if you recognize that using amortized cost method, there'll be a mismatch, right? The profit or loss will not show the clear picture. So in those cases, you'll be using the subsequent measurement or subsequent recognition through fair value through profit or loss. So those are the two subsequent principles. One is amortized cost and fair value through profit or loss. So this is from financial liability aspect. And then the compound instruments, right? The compound instruments. So compound instruments is the instrument which has the characteristics of equity as well as liability. So there's a way in which you're going to recognize a liability initially, and then how the balance becomes your equity, and how equity remains unchanged while the liability changes, right? So equity at the end, there could be conversion that's happening at the end of the term, right? So how that's going to be split between share capital and share premium, that you will have to know, and how you're going to derecognize the liability. If at the end it's equity that you're going ahead with. But if it's liability from the beginning itself, you will be using the amortized cost table and you'll be unwinding that. Okay. Then you will also have to know the effective rate versus nominal rate or coupon rate and how that's going to affect the expense versus liability and how expenses and liabilities are going to change. Okay. Now that's from financial liability perspective. And financial asset perspective, investment in equity instruments versus investment in debt instruments, what they are and why amortized cost table is used. Again, same question for you to ponder upon again. Subsequent measurement through FVOCI or FAPL. So there are two tests that you'll be using, right? So there is going to be business model test and SPPI test, right? What sort of business models and what sort of SPPI is going to get you to recognize through FVOCI or FAPL, right? For equity instruments or debt instruments, there are three ways: amortized cost, FVOCI, FAPL. How are you going to treat those? What are the different ways in which the treatment would happen? Okay, right. So why will FVOCI will be classified to FAPL when disposed in terms of debt instruments but not in terms of equity? Think about it, right? When you are disposing a financial asset, right? So if there was a financial asset in investment in that instrument that was held through FVOCI, that will be reclassified to FAPL. But when it comes to debt instruments only, but equity you won't. There is no recycling. Okay, that's what you call recycling. Transaction cost capitalization versus expensing, right? When are you going to capitalize and when are you going to expense the transaction cost incurred, right? Amortized cost and FVOCI, you are going to capitalize. FAPL, you are going to expense the transaction cost, right? Then the ECL model, expected credit loss model, the forward looking model. In this, what's 12 months versus lifetime, how the provision matrix works, and how the net interest component is going to affect. Okay, right. Then focus on initial measurement of financial instruments such as capitalized transaction cost, unless held through FAPL, impairment for ECL model, then purchase credit impaired asset, how we're going to deal with that, and how the reversals of impairment would work here. Modification of debt. So we saw lease modification already, right? We saw the revenue modification. So you need to master when the revenue modifications happen, contract modification. How do you deal with lease modifications? What are the ways in which lease modifications would impact, right? Then now comes the debt modification or liability modification. Then derivatives such as forwards, futures, swaps, and options. All right. So how derivatives work, and then hedge accounting, fair value versus cash flow hedge, how the hedge effectiveness component comes in, what is rebalancing, what is discontinuing. Okay, so you will have to spend a good day to understand all these peculiar elements of financial instruments. And there are some technical articles that I have highlighted here. Just make sure that you read those as well. So on this day, meaning whenever you are focusing on a standard, on that day you also will be required to read the technical articles. Now, as I mentioned in the beginning, it's not just going to be the theory revision, rather you're going to do more things. So one of it is reading technical articles, right, pertaining to those areas of content. Okay, right. Now before we move on to the next set of tips, just to give you all a good news that I will be doing a summarized all the standards in a nutshell version as well. So that also will be published for you to understand and review. So whatever we are speaking about, what are the questions I'm asking you, what are the questions, what are the things I'm asking you to ponder upon, will be clarified in that session, right? So it's going to be two sessions, one where all the technical standards will be covered, a non-group technical standards, and one session where all the group related technical standards would be covered. So we'll be having one session for non-group, one session for group accounting. All right. Okay. Now moving on to the next day, where we are going to look at IFRS 18 conceptual framework, IFRS practice statements 1 and 2. Now IFRS 18 is a key change, a key standard. So here you will have to know how you are going to deal with these categories, right? How you are going to deal with these categories. All right. And then subtotals. You also are going to look at how subtotals would work. All right. So these are the areas that you need to master in IFRS 18. Number one is the categories. Okay. Categories. And these are the changes we've seen, right? Then the mandatory subtotals. Okay. Then you have the aggregation versus disaggregation. Then there is labeling. So these are changes we're looking at, right? From IFRS 18 perspective. And then APMs versus MPMs. Okay. And how this operating category is dependent on main business activity. Okay. And how there are certain areas such as exchange differences that may affect either of these categories dependent on their original source. All right. Okay. So when it comes to conceptual framework, you need to be thorough with the entire conceptual framework of 2018, right? The conceptual framework, there are chapters that are in there, right? Then you also will have to try to evaluate how this conceptual framework is relevant and how it's applicable to all the standards that are out there. Okay. So when you do this, you are enhancing your skill of critical evaluation. All right. Then IFRS versus conceptual framework, how IFRS wins, meaning how IFRS takes precedence over conceptual frameworks. If conceptual framework says something, while IFRS say, the standard itself says something else. Now, for example, IAS 37 liability definition is different from conceptual framework 2018's liability definition. For IAS 37, the definition remains as per the standard. So in those cases, standards take the precedence. Okay. Right. And then practice statements, the materiality practice statement, you have to know the four steps, the quantitative versus qualitative materiality. Then the management commentary, you have to know the nature of the business, management objectives and strategies, entities, resources, risks and relationships, key performance measures, by, while focusing on the renewed or proposed changes to management commentary. Okay, there are changes that have happened already, but for your syllabus, it still goes as proposed changes. So make yourself thorough with that as well. Okay, right. Then moving on to the next day, right? So this is day 5. On this, it's going to be a mid important base day. So here, IAS 37, you have to focus on NRS contract and see the connection with IFRS 15, as I've shown the connection IFRS 15. Bring that back here, reiterating it here. Okay. Provisions using present value, unwinding of discounts, how the unwinding is impacting the liability, what the restructuring provisions are, and what amounts or what the expenses can be taken for provisions. In terms of group accounting, the requirement recognizing contingent liability as fair value adjustment, right? So group accounting connection here. I'll reiterating it back there. So here, even when there's a contingent liability that is required to be disclosed through a note, in terms of group accounting, you will have to present it, okay, as a fair value adjustment, and that impacts your goodwill. Then onerous versus restructuring, what's the difference, and how dismantling IAS 16 dismantling cost that's capitalized, how that's going to affect it. Okay. Then IAS 10 focus on how to evaluate whether evidence was present or not at the reporting date, right? It also, this standard is dependent on the evidence, right? Whether was there evidence present on the reporting date, and depending on the evidence being present, you would be deciding whether it's adjusting or not adjusting. Okay. Right. IAS 8 focus on when and how retrospective requirement for change in policy can be ignored based on standard requirement. Usually, the changes in policies require the retrospective adjustment, right? But there are instances where you would be ignoring that, and you would be the specific standards would take precedence. For example, IAS 16, the reevaluation model, when you change the models, now there's a policy change. But IAS 16 restricts the change. Why does it restrict the change? Meaning, not the change, it doesn't restrict the change, rather, it restricts the retrospective adjustment, right? So it requires you to do prospective adjustment. Why? Think about it. Okay. Then change in policy, how measurement, recognition, or presentation, change in either of this is impacting the change and making that change as a change in policy and not estimate. So how do you differentiate whether it's and how do you understand whether was it a change in policy or was it a change in estimate? So it depends on MRP criteria. If there's a change in measurement, if there's a change in recognition, if there's a change in presentation, that is a change in policy. Anything else, change in estimates. Okay. Right. And then there are certain aspects that are brought in from IAS 1 after IAS 1 discontinued and IFRS 18 came in as standard. There were certain items that moved from IAS 1 to IAS 8. Look at what those are. Okay. All right. Then moving on to next, the day 6, the ethics, right? So here you'll have to know the code of conduct, the ACCA code of conduct. You'll have to know the threats, the safeguards, and how to score professional marks here. You're getting 2 professional marks, 2 free marks here, but dependent on how you approach this question. Okay, so you'll have to know the ACCA's code of conduct, the principles, the threats, and how the principles are threatened, right? And what are the safeguards to take, and how to approach the answer, right? Pretty straightforward area to gain more marks. IAS 24, related party transactions, know the definitions, know the disclosures, know how government related entity, uh, the impact of IAS 24 on government related entities. Then the qualitative type of how it is a material, it meets a material threshold under qualitative type, even if the quantitative threshold is not met, even if the transaction from quantity perspective is not as much, right? But it needs disclosure because it meets a qualitative threshold. Okay, because there's a lot of manipulation, a lot of issues that pop up because of related party transactions not being disclosed. Right, it's quality based material threshold, which is open to manipulation. Okay, right. Then the next day, low important day. So here IFRS 8, know the definition, know the aggregation, know the quantitative thresholds, right? How do you aggregate and what are the quantitative thresholds? Okay, right. Then IAS 34 is interim reporting. So you will have to know the structure there. IFRS 1, the adopting of IFRS for the first time. How are you going to adopt IFRS for the first time? Then IFRS for SMEs, you will have to know the characteristics, what are omitted. Now, I for the SMEs, what from the usual standards are omitted here. Then accounting choices disallowed. What are the accounting choices that are disallowed in IFRS for SMEs, although they are allowed in other policies? Then what are simplifications? What are standards that are simplified, and what are those simplifications? And what are the advantages versus disadvantages of having an IFRS for SMEs rather than following the proper complete IFRS? Okay, so that's the tips for IFRS for SMEs. All right. So there is change that happened to IFRS for SMEs also. Just make a note of this and just try to look at what is the IASB changes to IFRS for SMEs. Not compulsory, but knowing it is always better. Okay. Right. Then on the next day, again, a very important day with IAS 19 and IFRS 2. So IAS 19, you will have to know the types, right? There are different types of employee benefits. There is Post-employment benefits, there's short-term, there's termination, there's other long-term benefits, right? And post-employment is the focus here, right? IS 19, the main focus is the post-employment. So what are the aspects here? So there's defined contribution plan, right? So here you are going to recognize the employment expense, very straightforward, this is. Then there is defined benefit plan. Now this is where this is the meatiest part of IAS 19. Okay, so this is where the complexity as well as the interesting nature of IAS 19 is visible. Okay, long-term liability at present value, offsetting pension obligation against plan assets, then report net. How you look at the obligation, compare the obligation and asset, and decide whether it's a deficit or a surplus. And depending on deficit or a surplus, you will be dealing with the items accordingly, right? What are the items? There are going to be interest component, there is going to be actuarial calculations, right? There is going to be service cost components. So these are all the items that are dependent on whether is it a deficit or a surplus. So you will have to show it net, right? Or you can even show it as a three-column table, right? Where you show the obligations, you show the assets, and you show the net. Or you can use the net structure itself, depending on whether it's a deficit or a surplus. The way you consider surplus, or the service cost, the interest expense would be dependent. If it's a net deficit, anything that increases liability will increase the deficit, of course. So you're going to add that. If it's a net surplus position, anything that increases the liability is going to reduce the surplus, right? So if it's a net surplus, you'll be deducting the interest and service cost, right? Well, if it's a net deficit, you'll be adding the net interest and service cost. Okay, right. So again, when we are discussing the technical non-group accounting standards, we will be going into the depths of how the three-column table or the net table would work. Okay, right. And actual calculation, how actual calculations are dealt with, you should master yourself there as well. Then you also will have to look at the remeasurement component, right? Which is a balancing figure between actuarial as well as year-end difference, and how the remeasurement component is recognized and presented. Okay, where do you present the remeasurement component, right? So it's recognized in OCI, and when it's recycled or not, you have to know that also. Okay, if anything that's recognized in OCI, there are two ways: recognized through OCI but recyclable, recognized through OCI, not recyclable, right? So know what is recyclable and what will not be recycled. Okay, back to P&L. Right. Then the asset ceiling, there's an asset ceiling test that you are supposed to know about, right? And how it impacts the statement of financial position. Now, asset ceiling looks at the low, it needs to be either lower of normal calculation and present value of economic benefits available in terms of refund or reduction in contributions, right? Now, let's say based on normal calculation, the asset value is 1,000, but based on the benefit, economic benefits that are being brought in, the present value of economic benefits is 900, right? Although this value is higher, the asset ceiling requires to use the lower value. So this is the amount. This is the cap. Okay, right. And then amendments, curtailments, and settlements. How are you going to deal with amendments, curtailments, and settlements? You will have to know it as well. So when you are revising IAS 19, pay close attention to the sections or the areas that I mentioned here. Okay. Right. IFRS 2 is equity settled share based payment versus cash settled share based payment. Again, this is a new area that's been introduced. So you will have to know what's an equity settled share based payment, what's a cash settled share based payment, what is vesting date, what are performance conditions. Now, performance conditions can be market based, non market based. What are those? How are those affecting the calculation? How are those affecting the recognition? How are those affecting the presentation? Right? Then the share appreciation rights, there could be hybrid transactions, hybrid meaning equity versus cash. So between those, there could be a hybrid setup as well, right? Some equity, some cash. Then group share based payment, in terms of group accounting, how does share based payment impact? How is share based payment is split between pre-acquisition and post-acquisition, right? How is it split between pre-acquisition and post-acquisition? So that is what you will have to master in terms of group share-based payment. An employee service is an asset that is consumed simultaneously. So the conceptual framework, right? When you take conceptual framework, there's a violation here. There's a violation here. What's a violation? When you take shares, so equity, credit, what's being debited? It's the employee expense, right? P&L. Okay. But what's the equity definition as per conceptual framework? Or what's the definition of expense as per conceptual framework? Expense is increase in liability or reduction in asset that reduces equity. But here what do you see? Expense is being increased. So when the expense is increased, meaning equity should have been reduced, right? What's happening here? Equity credit, meaning equity is increasing. The expense is also increasing. But conceptual framework definition says something else. Why? Okay, so you will have to figure that out. Okay, then we move on to important areas that is going to form question 1 of your SBR exam, the group accounting. Okay, so day 9 and day 10 is going to be allocated for group accounting. So what are the areas you need to master here? What are the areas that you need to pay close attention to? Let's look at it. So what are standards? Now first, so here we are going to look at from SFP, SPL perspective. So CSFP, CSPL perspective, as well as basic versus advanced perspective. Okay. Now, what are standards that are being covered? What are standards you need to know here? Right. There's IFRS 3 and IFRS 10. Very important standard, the standard you've already looked at in your FR level as well, right? So IFRS 3, IFRS 10. So here business combination definition versus concentration test versus elements of business, right? What is a business combination? What's a concentration test? What's elements of business? You know that. What's control definition, right? What are the 3 criteria that need to be met in order to have control, right? Then acquisition accounting, the contingencies, provisions, internally generated intangibles, right? Then goodwill, right? How contingencies are dealt with here, how the provisions are dealt with, how the internally generated intangibles are dealt with, and how goodwill is dealt with in terms of acquisition accounting. Now, what is goodwill? How is goodwill calculated? Goodwill is calculated based on purchase consideration, right? Plus NCI minus the fair value of net assets at acquisition. Yeah. So purchase consideration can either be cash, it can be share-based payment, it can be variable, can be contingent, may depend on conditions. Deferred, where contingent may happen, may not, right? Then deferred on a future date, paying on a future date, right? Share-based payment is based on shares, right? What's the pre-acquisition, post-acquisition, share-based payment, IFRS 2 implications here. And then there is share exchange that's missing here. There is another way in which you can pay, which is share exchange, right? Then measurement period consideration for provision amounts. If there are provision amounts, what is the period? What's the allowed period that you can have or in which you can make changes? Yeah. Then NCI, non-controlling interest, the fair value method versus net assets method, right? Then impairment, how goodwill impairment affects when the NCI is using the full goodwill method of fair value method or when it's using net assets method. So that's not full goodwill method. How the impairment is going to be allocated. Is it going to be allocated to NCI in both the ways? No. If it's calculated using full goodwill method, yes. But net assets, no. Why not? What component is required then? Just know that. Right. And then you also will have to know what are the exemptions from consolidation? What are the valid exemptions or valid reasons for exemption versus what are the invalid reasons, right? And then what is special purpose entities, right? So these are all given in your tutorial. When you're revising the theory, When you're revising technical areas, why I have given it here is for you to pay close attention to it. Okay. Then other standards that are applicable here is IFRS 11, joint operation versus joint ventures, IFRS 12, which is the disclosure of interest in other entities, IAS 27, right? This focuses on separate financial statements, how you either can, use, you can recognize that cost using IFRS 9 or using equity method here, right? Now, IAS 28, which is associate, okay, the equity method and the presentation of associates, right? And then you have IFRS 19. This is one of the other newly introduced standards, but a very small area. Just knowing what the criteria of these standards are is good enough, right? Subsidized without public accountability. Then changes in group structure. When it comes to changes in group structure, the changes can happen either from acquisition perspective or disposal perspective. Okay. From acquisition perspective, there can be mid-year acquisition. The acquisition happens in the middle of the year. Step acquisition, right? The acquisition happens step by step. First, it was a financial instrument, then it became an associate, then it became a subsidiary when the control was retained, right? The first there was nothing, so it was just a financial, it's just an investment. Then there was significant influence, becomes an associate. Then the control is obtained, becomes subsidiaries. That's step acquisition. Okay. Right. So non-control to control versus control to control. So when there's step acquisition happening, it can happen either from a non-control perspective to control, meaning associate to subsidiary. No control, here there is control. Or it can be within subsidiary to subsidiary, meaning let's say 70% before, now it becomes 80%. So it's within a control to control scenario. So how these two are different, how these two are, or these two require different treatment, and what are the treatments that's required. Okay, know that. Disposals, there can be step disposal, again a control to control scenario versus control to non-control. So opposite of this, you know, you sell from 80%, you sell 10%. That's control to control. Or let's say 60% becomes 20%, right? You sold 40%. Yeah, that's control to non-control. So non-control to control in terms of acquisition, the control to non-control in terms of disposals, where you're losing the control. Okay. And then when you dispose an associate, how are you going to deal with it? How are you going to treat it? Okay. Then there are subsidiaries acquired exclusively for resale. So what standard applies here? Right? Think about it. Then foreign subsidiaries, the connection with IAS 21, right? How the translation works, what the functional versus presentation currency is going to be. How are you going to figure out what is the functional currency? What are the criteria there? The exchange differences, right? What are the exchange differences that arise due to translation differences of foreign subsidiary, and how it's recorded in OCI, right? Again, a recyclable item, right? You can recycle it back to SBL. Okay, all right. They focus on functional versus presentation currency criteria and mechanics of translation, right? The mechanics of translation very simple. First, is it settled or unsettled? Depending on that, whether it's a monetary item or non-monetary item, right? And depending on that, there are different ways in which you translate. Either you use historical, or you call it spot rate, or you use average rate, or you use closing rate. Okay. Right. So again, when I take you through the technical aspects of group accounting standards, we will be looking at it in detail. Okay. Right. The group statement of cash flows, acquisition versus disposal of subsidiary, net of cash available in subsidiary, acquired. Right. So when you are acquiring a subsidiary, when you're disposing a subsidiary, how that cash that was there in the subsidiary is going to play a role, right? If there was cash in subsidiary, you pay an amount to buy that subsidiary, but when you look at the cash flow impact, you are getting some of the money you paid because they already hold some cash, right? So actual payment to acquire subsidiary was lesser. Okay, so you have to always do a net. When you're disposing of, you may receive, let's say, 10,000, but there was 1,000 already in subsidiary that is sold off. So in context, it is just 9,000 you're getting, right? This 1,000 was the money that from subsidiary that you're getting back. Yeah, so that's a net, right, impact there. Then cash paid to non-controlling interest, dividend paid, overseas cash balances, how that's going to impact your statement of cash flows, right? Now, this group statement of cash flow is a very important area, very under-tested, but a very important area. Okay, right. IAS 7, evaluate IAS 7. So this is the single element, non-group element of cash flows. So IAS 7 applies here. Uh, IS7 applies there also in group aspect as well. But when you take IS7, it's cash flow as a whole, right? Group and non-group elements, both are applicable here. Okay. So evaluate operating, investing, financing activities, how operating indirect activities is more important than direct method. Indirect method is what's more important. And what are the changes to cash flow statement after IFRS 18 has been introduced, right? And ways of reconciling profit to cash. How are you going to reconcile profit to cash? How are you going to bring profit to cash? Right? If a company is making profit, but that's not cash, right? So you're going to eliminate all the non-cash items. How are you going to eliminate those non-cash income? You are going to remove or minus non-cash expenses. You're going to add back, right? Because how do you arrive at the profit? Income minus expenses. So let's say there was non-cash income you considered. So you're going to minus that, right? There was non-cash expenses you considered, me you deducted that, so you add that back. That's how you're going to reconcile. Okay? Right. And then focus on how finance costs and dividends work in terms of own equity versus liability, right? Versus loan given to others and purchase of equity components of another entity, right? How the dividends and finance cost affect the financing section when it's own equity or liability, but how it affects the investing section when the loan is given to others and you receive interest. Okay, how that's going to affect the investing. Okay, then you also need to know to be able to distinguish between redeemable versus irredeemable preference shares. All right. Okay. Then on day two, you are supposed to remember or you're supposed to recall the five standard workings of CSFP, right? CSFPs, five standard workings, working one, working two, working three, working four, working five. So these are standard workings. What are they? Right? Fair value adjustments, a group structure, net assets of subsidiary, right? Net assets of subsidiary. So it can be pre versus post acquisition. What is pre acquisition net assets? That's going to impact your goodwill. What is post acquisition net assets? That's going to impact your retain earnings, the working five, and in CI working four, it's going to affect both of those working. And pre-acquisition is going to affect your working three, goodwill. Okay. Right. Then goodwill, cash, upfront, deferred, liability impact, contingent, right? And non-cash considerations such as share exchange. LCI, fair, well, full goodwill method versus percentage method, as we've already looked at. Then you have to focus on fair value adjustments on depreciating versus non-depreciating non-current assets, right? If there is fair value adjustment done on non-depreciating non-current assets, post-acquisition period will not have any depreciation elements. But if it is for depreciating asset, post-acquisition period will be considering the depreciation effect as well. Okay, right. Then you also will have to be thorough about the inventory value at acquisition, right? The IFRS 3 based inventory value was IS 2 based inventory value, right? Where IS 2 requires you to record it at lower of cost and NRV, but IFRS 3 requires you to record in a different mechanism. What is that mechanism, right? Assets and liabilities not included in the subsidiary statement of financial position, such as internally generated intangible assets and contingent liability, but this will be required to be recognized in parents, as we already discussed. What are those? How are we going to treat those? Okay. So be particular about elimination of intragroup transactions. So what are the eliminations? The provision of unrealized profits on inventory, on non-current assets, loans, receivables versus payables. So these are inter-company transactions, intra-group transactions. Okay. Cash or goods in transit adjustments, dividend versus interest adjustments, CSPL adjustments in group retail earnings of CSFP. So remember, if there is only CSFP given to you, they require you to adjust CSFP only. How are you going to treat the CSPL items? So that's going to impact the retained earning working, which is working number 5 from your standard working. Okay. So anything that affects CSPL, if there's no CSPL required, then you are going to do all those adjustments under retained earnings. Okay. Right. Then check for disposal adjustments as well. How are you going to deal with disposals? Then consolidate statement of profit or loss to be particular about full year versus mid year acquisition, because the line on line, right? Consolidation will be time apportioned depending on how many months you have acquired subsidiary, which is why it's really important to know whether is it a full year acquisition or is it a mid year acquisition. Okay. Then focus on elimination of intragroup transactions. So what are intragroup transactions pertaining to CSPL? There is sales and purchases, PURP on inventory, profit on NCA transfer, and depreciation adjustment on transfer, loan interest versus dividend income. So all these are going to affect the CSPL. Hence, you will have to eliminate that. So remember to do that and go back, refer to it, become a master. Take care of CSPL adjustments, goodwill impairment, excess depreciation, amortization, fair value adjustment at acquisition, expense professional fees incurred through acquisition, right? For during acquisition, if there are any professional fees that were incurred, such as broker fees, you are going to expense that, right? Unwinding interest cost and deferred consideration also is going to impact the CSPL. So you have to take care of these, right? CSPL adjustments that have an impact because of the acquisition, right? So what are they? Goodwill impairment. The impairment is going to affect the CSFP as well as CSPL, right? The expense there pertaining to CSFP full, CSPL particular to the year. Okay. Excess depreciation, CSFP as well as CSPL. Okay. Likewise, professional fees to be expensed, unwinding interest cost on deferred consideration, CSFP as well as CSPL. Change in contingent consideration, right? If there's change in contingent consideration, any change will be recognized through profit or loss. Okay, right. Then you will also have to remember the NCI working for profit attribution. When you're attributing profit between parent and NCI, there's a working you do for this, and it is the remaining figure that goes to this. So, what is this working? How do you do that? Okay. Right. And then in terms of associate, remember equity accounting and focus on signs of significant influence versus control, right? There are different ways in which you understand significant influence. There are different ways in which you understand control. Evaluate whether is it significant influence or is it control. Okay? Based on that, you'll decide whether it's a subsidiary or an associate. Then analysis and interpretation. So here you have to focus on IAS 33, special focus on diluted earnings per share. You covered it completely in FR. Back. Group statement of financial position, statement of profit or loss. Okay, so in terms of group statement of financial position, statement of profit or loss, and statement of cash flows, how are you going to analyze and interpret those? Right. So here you have to pay special attention to intra-group loans versus sales and purchases versus unrealized profits versus synergy versus performance as a group versus individual company. Now you have to provide the interpretation focusing on all these elements. Right. What's the synergy that was brought in? What was the synergy's impact? What are the performance of the companies as a group versus individually? What is their performance? So you have to do the interpretation at a higher level. Okay. Then cash flow interpretation, where negative cash flow in investing activities is technically positive. Positive cash flow in financing activities is usually risky, meaning you've got more cash and you've actually taken more loans. That means, right? And investing activities, if there's a negative cash flow, meaning you have invested more, purchased more assets, which is good in long term, right? So think of it from that perspective. And APMs, non-financial performance measures, IFRS S1, S2, MPM. So APMs, MPMs also forms a part of your IFRS 18 revision. Okay. right? And then current issues, you're supposed to focus on contemporary issues, right? Mainly IFRS 18, as that has already come into play. You won't have to consider it under the current issues, rather the proposed management commentary, the changes in proposed management commentary, IFRS for SMEs, and different new developments in IFRS standards. Okay, right. And then on day 13 and 14, you'll be practicing questions pertaining to ethics. 15 pertaining to current issues. Day 16 to 18, practice questions FR standards related, right? 1921 practice questions SBR standard related. FR meaning the standards that you already had studied in FR, which also were in SBR. And SBR standards related, meaning new standards that were brought in, such as IES 19, IFRS 2. Okay. Then from day 22 onwards, you start doing past papers. So when you are starting to do past papers, you will be doing 3 past papers every day. From day 22 onwards, the intensity increases because technical revision requirement reduces. You've already done that. Now there's an intensity of back-to-back past papers. So you do 3 past papers every day. Okay, 3 past papers, and after doing each of the past paper, review your answer, then read the relevant examiner reports, then look at the areas that you were unable to respond to and revise those respective standards only, right? Look at what was missing, why you were not able to recall, and try to recall those areas from standards. And you do this, right? You are going to do this for the rest of the period. Okay? Right. So day 13 to day 21 is practice questions. So you use Kaplan, you use BPP, whatever the materials you can use, because those are also past paper questions. But from day 22 onwards, you start doing past papers. So day 22, 23 is going to be same setup, 3 past papers, relevant examiner reports of those past papers. Look at your answer, review your answer, look at the areas that you found difficult, the areas that you did not manage to complete, go and revise those standards. Try to recall, try to see what went wrong, why did it go wrong. Okay? Then on day 24, attempt the pre-June mock under exam conditions. Timing, the setup, the environment should be exam conditions based. Okay, why on day 24? Because if you do it on day 24, you have enough time to go back and revise, go back and recall the areas that you still are struggling with. So day 24 is for pre-June mock under exam conditions. Day 25, again, the same setup of past papers, 3 past papers, relevant exam reports, revision of standards, right? After you review your answers. Day 27, all the same thing. Day 26, I leave for specimen exams 1 and 2, which is on the it's a ACCA practice platform, right? CB practice platform. Then day 28, 29, 30. You revise theory, you watch topic explainer videos, you look at examiner articles, you look at technical articles, right? You revise standards, you practice, do wider reading, do all that's going to be important for your last moment preparation for the exam. Okay, so additional advice I give you all is read exam reports after attempting each relevant past paper. Very important. Exam reports, very, very important, because that is where you understand what is the examiner's expectation and where are you standing at. Okay, read ACCA technical articles, including FR, right? SBR, read everything. FR, also try to read the critical ones that I've highlighted especially. Then practice question on CB practice platform. As soon as you start practicing pair questions or past papers, do or any questions rather, do it on CB practice platform, because you will need that practice. The more you practice, the better you become in using the ACCA CB platform. Okay. Right. Then attempt practice exams, sample exams, specimen exams, attempt last 8 past papers that's out there. Attempt pre-June mocks are once released under exam conditions, no compromise there. And complete Kaplan revision kit entirely twice, right? How are you going to do that? So I've given you daily dosage. I told you with technical revision days, there are other things that you'll be doing. One, you'll be reading technical articles, and another thing you'll be doing is you'll be attempting the Kaplan revision kit, or if you're using BPP, you can go ahead with that as well. But Kaplan also has all the A past exam questions, so you will be doing 3 questions in the morning, 3 in the evening. So there is 66 questions in Kaplan kit of 24, 25. So in 11 days, you'll be completing 1 round. 22 days, you'll be completing 2 rounds. In 22 days, you'll be completing Kaplan revision kit twice. Again, you can tweak it to the pace and speed that you find comfortable. But try to complete Kaplan revision kit at least once. Okay? Right. And then watch topic explaining videos and the FR technical article sections for the areas that are important and integral, such as IFRS 15, IFRS 16, financial instruments. All right. Wishing you all the very best. Try to use this, try to stick to this study planner. And if you follow it as it is, or if you tweak it and follow as much as it is there, you will be prepared to score very high in your SBR exams in June 2026. I will see you again with the sessions on financial standards, one focusing on non-group, one focusing on group. Until then, stay safe, take care, and have a great time ahead. All the best.